What's up, everyone? Dylan here. I wanted to hop on to do another episode of the weekly analysis video. With that said, we'll hop right into it. Going back to Friday, we had the largest move to the downside that we have seen since April 10th. From peak to trough, the Nasdaq fell almost 5% in a single day. Okay, what happened? The United States and China trade tensions reignited. Okay, a little bit more specifically, this is from Goldman. China announced last week that it will expand its export controls on rare earth minerals, impacting global supply chains and high-tech industries. And in response, the U.S. has threatened 100% tariffs on Chinese goods and controls on critical software exports. Okay, so again, the market took that information and they absolutely sold it off, and the bears were in complete control that day, basically closing right near the lows. And even beyond the 4 p.m. Eastern time close, Trump came out with additional news, and you even got some further downside pressure after the market closed. Okay, so let's talk about the price action. Okay, last week's video, I did a video on whether or not AI was in a bubble, and I talked about a specific trend line that I would be using to gauge the relative strength and weakness in the semiconductor / AI space. It was in SOX, right? This trend line stems from the high of 2022, and it latches onto the high of July 2024. You could see in hindsight that it tested there numerous times, 5 different days leading up to that Friday massive sweep to the downside. Going forward, this line will remain very, very important. Obviously, for bulls, they would want to overcome that line and sustain value above. And for the bears, they would want to continue to keep a lid on price each time it gets up there. Okay, so this level worked very, very well in anticipation for that downside move. Okay, another level that I've been talking about in recent videos is 18.6 in the VIX. Okay, very, very simply put, when the VIX wakes up, it puts pressure on the S&P. So we come over here, and a few weeks before that Friday massive drop, right, I was talking about the VIX, right? And in subsequent weeks as well, I continued to talk about that 18.6 level. If ES revisits lows, that VIX 18.6 level will be key. Sellers need the VIX to break above and sustain. The higher the VIX goes, the more pressure is put on ES. So when that occurred, right, when the VIX broke above 18.6, it quite literally exacerbated the move to the downside in the S&P. You could see it broke above with nice momentum, and it continued to the upside, at good length. Okay, and subsequently, right, or in tandem, right, it broke below this 6740 level on the S&P and absolutely got crushed. So the fact that the VIX was able to do its part in putting additional pressure on the S&P allowed for the S&P to really, really get crushed for, in a big manner, right? More so than it would have if the VIX was lagging. Okay, that's very, very important because we'll get into a further level later on in this video. So with this massive move to the downside, I actually bought the dip. Okay, so I bought the dip on Friday, and I'm going to get into that now. So to be very, very transparent, I talked about where I was going to get into the market on the long side and why in previous videos, but I'm going to go over it again here. So basically, the line that I was really focused on for weeks was this trend line stemming from May 2023, and then you latch it on to June 2020 or May 23rd, 2025, and then you latch it on to June 22nd, 2025, okay? And that is where I started to buy the dip, okay? So I want to be very transparent, right? This was posted to the Discord members in the Academy, and I bought 10 different stocks. I'm showing you guys 3, and, to keep the stocks exclusive for the members. But I bought 10 different stocks, and I used the TWAP order from about 3:27 p.m. Eastern time to the close. So it was about a 30-minute TWAP order that, got me into these positions as the S&P got to the trend line and continued lower. I was averaging into 10 different names, okay? Obviously, you could see Google, TQQQ, and SOXL were 3 out of the 10. Okay, so I want to get into why I bought, because you could argue, oh, well, Dylan, VIX was strong as anything. S&P and the Nasdaq were absolutely getting crushed, right? Rallies were getting sold into, right? The bears were in complete control. Why would you try, buying buying a falling knife on a day that the bulls were totally inactive? Okay, and I have my reasoning, obviously. Okay, so to start out, right, we're gonna look at the 4-hour RSI. Okay, you could see the last few times that the 4-hour RSI has gotten into oversold territory, it has caused bounces. Okay, so I'm gonna go ahead and draw these out. And basically what I'm about to say is, if you see this occurring, right, time after time after time, where this type of pattern continues to occur and continues to be effective, you would be stubborn to ignore it, okay? So that was the first thing, the fact that RSI was dipping into oversold territory, okay? And in fact, it got all the way down to where it bottomed on this particular day back in August. You could see it basically double bottomed at, call it 19 on the RSI on the 4-hour chart, okay? So again, that's one thing. Another thing was the fact that 2 out of the 4 major indices that have been leading on the way up got bought right at their 50-day moving averages. So what do I mean by that, okay? S&P, let's look at this three-month figure down here. So over the last quarter, the S&P is up 5.88%, right? Nasdaq is up 7.22%, Dow Jones is up 4%, and the Russell is up 11.85%. Notice that the 2 relatively strong were Nasdaq and Russell. They absolutely outperformed the S&P and the Dow Jones over the last 3 months, okay? So by using the relatively strong names, ideally in a bull market, you want to see that the relatively stronger indices are able to bounce at areas of support. What does that do? That tells you that the uptrend is still intact if the relatively stronger leaders are doing exactly as they should in terms of getting defended on dips. Okay, so we go to a daily. I'm using the cash, the CFD, the cash for these different indices. I'm not a big fan of using the futures when using long-term moving averages because of the rollover periods kind of skew the data. Okay, so for this case, we're going to use the cash. So US 100 is the Nasdaq, right? Look at this, 50-day moving average got right down into it. There's no coincidence there, okay? Also, US 2000, which is the Russell, what do you know? Also, almost perfectly went right into the 50-day moving average. So the 2 stronger indices both came right into the 50-day moving averages for the first time in freaking weeks, right? And the S&P 4-hour RSI, right, got into oversold territory, which again, as I pointed out, got bought the last 3 times prior. Okay, so again, you would be foolish to assume that this scenario is any different than the other 3. Okay, so that was another thing. Okay, so there were more to it, right? I'm going to go over one more with you guys. There was more, but I just wanted to point out some of the main ones, okay? The other one was the fact that the 4-hour RSI on the VIX double topped where it got up to during the April highs, right? If you come down here to the RSI, you could see if I point out exactly where it topped out, let me zoom this in a little bit. The RSI topped out on the 4-hour chart back in April, following that Liberation Day crash, right at 84.3. That's exactly where the VIX got up to as well on Friday. Okay, you can see that's perfect double top, as well as it came into a key area of resistance as well. This double top resistance back here. Okay, so again, you had S&P, RSI, you had the Russell and the Nasdaq coming into 50-day moving average, and then you also had this RSI as well as a double top resistance that it came into. Okay, so was it risky? Was it risky to buy the dip on a falling knife day where the S&P and the Nasdaq had their biggest down move in months? Yes, but you have to understand that there was conviction involved, and if you saw in that post from the Discord, these were starter positions, right? Again, starter positions. So basically, the thesis of this play is to look for a bottom to occur into the third week of October, where the seasonality tends to kind of pick up some support leading into a November/December rally. Okay, so essentially what I was looking to do is to start buying the dip on that day, on that Friday, and continue to add to those positions if it continued to the downside. Okay, so I actually wanted it to continue to the downside because I would add to those positions at lower prices. Okay, so since adding those 10 stocks, I've gotten out of 5 so far, not fully. I've scaled out of 1/4 position out of 5 out of the 10. Okay, so that's where I'm at now. Basically just raising capital for if the market does go back to the downside, I'll have some profits to kind of reload into more position to add into. Okay, so that is where I will, I'll leave it at that. So going into the seasonality, this is from Scott Rubner from Citadel, right? He talks about basically what I just talked about. So in this picture, right, the S&P 500 monthly performance by day since 1928, basically the last century, you could see that the market tends to bottom in that third week of October for a nice move to the upside, right? October ranks among the choppiest months for equities, right? That's literally kind of what we've been seeing, especially since Friday. On average, October 26th marks the Q4 low for S&P, and then October 27th marks the Q4 low for the Nasdaq, right? Usually, on average. Late October dips technically set up for powerful year-end rallies, and then strong years heading into Q4 typically have stronger moves higher into year-end. All of this is going with the thesis, okay? So he does a very, very good job explaining. Okay. Also, he posts in this newsletter, Citadel Scott Rubner says, while near-term headline risks may continue to fuel volatility, the underlying equity market primary trend remains constructive. Strengthening corporate fundamentals should underpin the next leg higher as we enter a historically strong November. So this is a good screenshot of some of the things, and then that excerpt kind of doubles down on what he has here. So again, that goes with my thesis, okay? And then over the weekend, after that Friday drop, Trump came out on Truth Social and said, quote unquote, don't worry about China, it will all be fine. He also added that he doesn't want a depression for China and that the USA wants to help China, not hurt it. And that is why we gapped up, on that Sunday night reopen. Not only that, but since then, we've also filled the gaps on both the S&P and the Nasdaq, right? Those weekend gaps, which clearly shows so far, not only did the Friday dip get bought, but also the gap fill got bought as well. The bulls technically are still in control despite that Friday move, okay? So that's where we are now. Again, I would actually prefer a downside move in the equity space to add to those positions. But if we don't get another move to the downside, I will continue to scale them on the way up. Okay? So that is that. Going forward, if we do get further moves to the downside, right, the key spot to watch are those Friday lows on the S&P and the Nasdaq, okay? S&P and the Nasdaq, if and when those are revisited, those lows from Friday, okay, the main thing you want to watch is the VIX, okay? So if and when the S&P and the Nasdaq get down to Friday's lows, you need to see that the VIX is able to get at or above that 22 area, that 2195 area, okay? Because if it doesn't, right, if S&P breaches Friday's lows, yet the VIX cannot take out that 22 level, that would show that the VIX is lagging, which would allow for the bulls in the S&P to have a better ability to defend that dip, okay? On the flip side, if you have the S&P and the Nasdaq both breaching below Friday's lows and the VIX is at or above that $22 mark, then it would set up for the highest likelihood that the S&P and the Nasdaq will continue to the downside as that additional pressure is on the indices, okay? So going further beyond that, let's just assume that that occurs, right? Where the VIX takes out Friday's high and the S&P and the Nasdaq also take out Friday's highs, okay? The next spot to gauge on the VIX would be up here, okay? This 25.4 level, you could see it was a double top, right? Double topped back in what? Back in August and July. And then it also lines up with the anchored VWAP from the April highs, right? So if we latch an anchored VWAP into that April high, that's exactly where it lines up, that 25.4 level. So if and when Friday's lows get broken on S&P and the Nasdaq and the VIX can take out that Friday high, this area up here would be the next spot to gauge, where if the VIX were to fail at that 25.4 and the S&P is at an area of support, that would set up for the best likelihood that the bulls can defend the dip on the S&P. So you're literally just inversing the roles, okay? So that is that. Going forward, a lot of people are still talking about the fact that the Nasdaq and AI and all of this bubble talk, right? So another thing that I wanted to talk about is the fact that the Russell has been showing relative strength, as I showed you guys in the beginning. But a key level going forward is this double top that it failed at today, right? This double top stemming from November of 2024. This is with the contract adjustment setting on. If you don't have that setting on, your chart will not look like this, okay? But essentially, if and when that Russell takes out that level, it still has way more room to the upside than Nasdaq does, in my opinion, okay? And the reason for that, I have a few different images here from Deutsche Bank, okay? You could see, this is one image. You could see that the Russell, right, small cap positioning is far from long, right? Plenty of chase potential there. So funds and just positioning in general is very, very underweight in the small cap / Russell. So you can see this is going back all the way to 2010. It's basically flat right now. So there's a lot more, there's like a vulnerability for the Russell to squeeze to the upside as funds and investors go to chase those highs, right? Because they just don't have a lot of exposure to the Russell. Okay. On top of that, there's these two images here, right? Which double down on that point, right? Plenty of shorts in the Russell as well, right? You can see the green is the Russell, whereas the S&P and the Nasdaq are the purple and the orange. And you can see the short interest in the Russell is far greater than the other indices, okay? And then over here, very similar to the first image that I showed, the positioning remains relatively depressed, especially when, considering how the Russell has ripped. So the Russell has been very, very, very strong. What did I say? 11% higher in the last quarter. I believe that's what I showed you guys earlier. Yet you could see that green, right? The asset managers and leverage funds have a very, very small. In fact, it's actually negative. They're negatively positioned, meaning they have short positions despite the fact that the Russell has been ripping. So on the flip side, the Nasdaq has a lot more crowded positioning. So if and when the Russell can take that high out, I think it's going to outperform the Nasdaq, or at least it's setting up where that would be, a safe bet. Okay, so despite the Nasdaq, people saying, "Oh, we're in an AI bubble. It's way too crowded. It's overvalued. This, that, the other thing." Basically, the Russell can pick up a lot of that slack if it starts to outperform. So I want to put that out there as well. That kind of goes along with, my thesis as well. And if I'm wrong, and the S&P and the Nasdaq do break those lows and really, really get crushed to the downside, the next macro level that I will look very, very closely at and probably get involved in another dip buying opportunity is that 6120 on SPX, anchored VWAP from April lows, which also lines up with a retest at these previous highs. Okay, so that is the macro level. If things get really, really ugly between China and US, that would be a very key level to look at going forward. One more thing from Goldman before I end. Look out for continued volatility, right? What we've been seeing, it's been the last couple of days have been tricky because it's up, down, right? Like headline bombs left and right. It's been very volatile. So this is from Goldman, and I agree with this stance. They say, our economists believe that while these moves could disrupt markets if fully implemented, right, talking about the U.S. and China trade tensions, they may primarily serve as negotiating tactics ahead of the upcoming U.S. and China talks. Okay, so you could see Xi and Trump have been going back and forth, really escalating the trade war, and yet they're meeting to get together and try to figure out an agreement is still scheduled for the end of October. So for the next 2 weeks, you may continue to hear a lot of that nonsense back and forth, a lot of whipsaw volatility, which isn't ideal for many of us. But just know that it should primarily serve as negotiating tactics for those talks at the end of the month, which hopefully set up for a clearer move after those talks, get done and over with. So that is where I'm at right now. Again, hopefully you learned something. Hopefully you pick something out of this video. And if you have any questions, feel free to comment, and feedback is always appreciated. That's it from me. Peace.